It's a market melt up. This is a streaming red alert buy signal. Our high risk strategy is now up 264% year to date, turning every $10,000 into $36,400. And we didn't make you work for it. In fact, we hate changing positions. We're very slow to make changes. Right now, if you're starting a new free trial and wanted to put $10,000 behind our strategy, here's your current trade alert recommendation. You'd be buying 31 shares of UVXY, the crash insurance play. The stock market goes down, this product goes skyrocketing up with an asymmetrical return, much like a life insurance policy. We're betting big on Ethereum with Grayscale Trust, ETHE. This is actually trading 10% below par. So if you like Ethereum, instead of buying it at Coinbase, you can actually get a 10% discount with the Grayscale Trust today. 157 shares. I think we might see this product go from 4,000 to 8 to 12,000 before we hit a short-term top in the market. So very bullish on that. The only thing that keeps me up at night that could be a problem is inflation and rising interest rates specifically, which would mean the bond market's starting to crash. And that is bad news bears. We're hedging against that by being long the big oil and gas companies using the ETN NRGU. That's your big US oil gas companies leverage times 3. It's the ultimate inflationary hedge. For a short-term play, we're long natural gas with Boyle. Europe is having a crisis, and we've been sending flotillas of natural gas from the US to Europe. But this is just a short-term fix, and we're expecting this to potentially double by February. After that, we'll look at the next big inflation, which I think you're going to see in food, because we're seeing fertilizer costs go skyrocketing. The new variant that the left-wing media wants to go crazy about, in my opinion, is extremely bullish. Biden last week confirmed no new lockdowns or new mandates, just massive testing. So we've got places like New York, California, Chicago going nuts with all sorts of policies, but in general, I don't see the risk of a global shutdown and oil spiraling to zero like we saw 2 Marches ago. So this is extremely bullish for how we're positioned. Now, what's interesting is this new variant is bypassing the immunity for natural and folks who took the medicine. The good news is it's very, very quick. That is not creating a long hospital stay. Seems to be around 50 times more infectious, but 1/10 as deadly. This means humanity may be on the verge of herd immunity within the next 60 days. This could set us up for a grand reopening starting in March. So that's what we're really looking forward to in terms of how to play the markets. Meanwhile, I do believe Joe Manchin and Schumer will make a deal. We'll see what that deal looks like, but if there's one thing politicians do well, it's spend as much money as possible. Only thing that could stop them would be uncontrollable inflation. We'll talk a lot about that in this presentation. For the last 20 years, we haven't had to deal with extreme inflation. Many people lived through the 70s, and you know what that's like. So we'll talk about that and how likely it could happen this decade. China, Japan are firing up the money printing as the US is slowing down its money printing presses. And these exponential cases may slow down inflation and peak CPI in 90 days. Now, the catch is China has this zero policy. So the spread of this new sickness is inflationary when it starts to shut down ports in China. But it's deflationary when it starts to cool down energy demands here in the US. So this is very hard to speculate exactly what the impact will be on the CPI. But perhaps this gives enough uncertainty to cause a delay in the Federal Reserve hiking interest rates, which is going to be what ends this bullish party if they hike too fast. Let's take a quick look at our track records. We were having some drawdown in our safe growth strategy, and that drawdown has collapsed. We're now up 27% year to date. This is where we recommend you put most of your money. It's a global stock portfolio with a whole bunch of different inflationary hedges. Our more risky strategy is now up 264% year to date. It's cut its drawdown in half, only down 11%. And like I've been telling you, this is the portfolio. When you see drawdowns, pounce on it, because that tends to be when we have the best returns immediately after. Let's talk about the key macro to focus on as we approach 2022. Congress increased debt ceiling by $2.5 trillion. What if I told you that's just about the only thing that really matters for global markets, whether or not the US is going to grow its debt? And I'm going to say it needs to grow it by no less than $2 trillion a year to keep the party rolling in the stock market. If they spend less than that, the fiscal cliff is likely to create a deflationary shock in global economies. But McConnell gave them this on a silver platter. First, he did it in September when we had the debt ceiling fears. Then he did it again in December. So there's really a very long time frame where Congress can pass this new budget without the markets getting too upset. And here's a look at that deficit spending. Record deficits under the great Trump, the biggest spending package in history. So all this inflation is being blamed on Biden, but it's really from Trump's multi-trillion-dollar spending packages he pushed through. So this is the most important thing. Now I want you to know in 2001, we had a debt surplus, okay? And that's when you got a 2-year stock crash. Notably, ever since then, we have had a trend of dramatically increasing debt, and this is what is the main driver of stocks. So if we run 2 trillion in debt this year, don't be on the wrong side of the trade. That's my main advice. So all they have to do now is agree on how to spend the money. Plus, we now have trillions in corporate stock buybacks, record levels coming through. Sure, you get headlines that CEOs are selling at the fastest pace in history. They're also selling at the fastest pace in history the previous year and the year before that and the year before that. China is likely to bail out its real estate market. 2/3 of the wealth of Chinese are parked in real estate from many generations. So unless he wants to have a populist rise, overthrow the communist government, they really need to stabilize that real estate market. So I think they're done with their tightening and getting ready to turn on the printing press, as the US is going to have to start to slow down and raise interest rates to fight inflation. We did predict Turkey would get bailed out, and I believe that's the turning point in the markets was the Turkish lira getting bailed out. Looks like the government is guaranteeing any losses on Forex, which is funny because if there are losses on Forex, then they'd have to devalue the currency by printing more money. So very, very interesting. I think that's probably one of the key pairs to watch is USD TRY. And so it retraced from what was it, 17 all the way down to 11 when a whole bunch of US dollars were shipped into back its debt, and it's starting to rise again. So we'll keep a close eye on it. That may be one of the best leading indicators for risk that we can keep a close eye on. Steven says, what's Forex? That's currency trading. Now, I believe there's a very low chance of labor growth or rising interest rates soon. I think this could potentially start to become a problem starting in March. So that means don't sell your tech stocks. We have remained long, and they're leading the market higher today. Cash is trash. Okay, we know governments globally are debasing their currencies at no less than 5% a year. Okay, and the reality is it's much worse than that. We're seeing inflation, true inflation in the 15 to 30% range. So cash is really not a good place to store wealth currently. It would take quite a scenario for the dollar to go up considerably from here. Meanwhile, the bond market, I believe, is also the most overvalued asset in the world. Typically, we want to see the CPI even if it's fake from the government, printing around the same rate as the interest rate of our 30-year bond. But right now it's trading at least negative 5%. So my expectation is the bond market will crash over the course of time and take everything else down with it. And we need to hedge against those interest rates rising until they create a crisis. So growth to value first, and then we can worry about the price of energy causing a shock to the economy. That's really the outlook I have. So investors really have no other logical option. Where else are you going to put your money? We got to be long stocks, crypto, and commodities. I believe they're going to melt up again until the bond market becomes too attractive. So our greatest fear, funny enough, is a strong labor market, which would cause rising interest rates. And this is going to be a key market threat to a bubble such as which we're living in today. Now, here's what's critical. The Fed could pop the bubble before the markets do themselves from inflation. So if we don't see the PPI and then following behind it, the CPI to slow down in the next 90 days, I believe the Fed is going to start to tighten into a slowing economy and create a crisis. So we really need the Fed to back up on these anticipations of 3 to 4 rate hikes this year alone, and then 3 or 4 next year. If we don't see the PPI and CPI starting to at least stabilize and stop rising rapidly, that's going to become the key threat to markets. And this is not something traders have had to deal with over the last 2 decades. Okay, so we had Alan Greenspan come in with interest rates at 18%, and you've lived in 2 decades of a luxury of low inflation, globalization, and the ability for interest rates to head towards zero. But now we're bouncing up and down off of zero, and there's signs telling us this inflation may be worse than we think. So we'll see how this plays out in the next 3 to 6 months. But that's going to be very critical to watch. So you really need to join us live every Monday, Wednesday, Friday to be ready for the trade alert. Right now, we're betting big on inflation and that the Fed's going to be slow to react and not do enough to really kill it. If we go back to the Paul Volcker days, guess what? They had to hike interest rates above inflation to do the trick. They're talking about some very small rate hikes today. And granted, we're now sitting on $300 trillion of global debt. So the market's going to be very, very sensitive to interest rates going up. My bet is you won't see the 30-year ever go above 3% again, because it'll create a financial crisis and put the Fed back into printing money. So what if I'm wrong? What if the rich folks just pull the carpet under us and just sell? They sell those stocks in mass. Well, we're protected against something going haywire with a product called UVXY. It's the VIX. And this can go up 1,000% if we get another crash like 2020 of March. It went up 1,100% in 4 weeks. So a 10% position literally more than doubled your entire portfolio. The other 90% could have gone to zero and you didn't care because of your insurance policy. There's no other hedge today that makes a lot of sense. So get ready as we watch these data prints for the signal to start to increase hedging. Right now, I have us running relatively light because I don't see a considerable threat to change where money is flowing into currently. And like I said, unless the dollar or the bond market becomes attractive, there's really nowhere else for you to go. So we believe now may be the best time ever to begin following our high-risk growth strategy and safe growth strategy. What I really recommend is putting 70% of your money in the safe growth and 30% in the high risk. That gives you a really nice portfolio mix. Now, big picture, the formula is crash the economy and then respond with suppression of interest rates and lots of money printing at the government level. And you get these 5-year bull markets in commodities. That's exactly what I see coming our way. So that means people over time are going to start to rebalance from being super heavy in tech and crypto and buy up some of those boring old assets like banks and energy companies. Now, we're particularly focused on the energy companies as the single greatest hedge for our growth position. So I'm not saying dump one or the other completely. We like to have the right balance. And as we get the signals that interest rates are going to rise, we're going to get heavier in the value and start to pull profits off the growth, which would be, again, your crypto and your tech. So here's the whole economy in one picture. Last year, Trump gave a $1 trillion stimulus package in December, and Biden kicked off the year with $2 trillion in stimulus. And what was the impact? Well, first, growth and value went up together from December through February. Everybody was making money, but those interest rates began to skyrocket up, which means the bond market was crashing. Now, what happened? In March, we saw Bitcoin and the big tech giants sell off. Now, crypto went down something 50%, whereas the tech giants were able to only go down about 15%. Now, it's a little bit different story. The FANG stocks recovered. All of the stay-at-home stocks like Zoom and Peloton and everything else got crushed, and they really haven't recovered since then. So very interesting development. But in green, we call that value. That's energy. Candlestick is growth, and yellow are interest rates going up or down. Now, the economy did not recover. We had a very slow recovery, lots of lockdowns, all sorts of problems. China started to tighten up. So interest rates came flying back down. Now, the energy really didn't get crushed. You can see it's kind of flatlined, but those growth stocks came rebounding back up. So that's really the strategy we deploy here at Portfolio Builder. So there's a lot more to explain. If you want really good one-on-one help, call John right now. He works for Portfolio Builder, and he can walk you through our entire product. Just give him a ring at 505-610-1334. Okay, so real quick, let's see, safe growth strategies now up 28% year to date. We wiped out that drawdown, told you not to budge, and sure enough, that was the right call. Safe growth is up 268% and cut that drawdown in half by that dip. If you're following the 70-30 strategy, you're currently up 113% year to date. So a really nice combo. Now, to get the safe growth strategy, you do have to upgrade your free trial. And what's neat is you're going to have access to our software in the membership area where you can punch in how much money you want to invest. Let's say it's $100,000, and it's going to calculate exactly how many shares of each ETF to purchase. And because we all follow a very specific ratio of shares, our entire member base gets the same return over any period of time. And you just have to control how much money you want in the safe growth global stock strategy compared to the very targeted high risk strategy. Is it 90-10, 80-20, 70-30? That's your choice. Okay, very good. So let's go ahead and hop into today's data. First of all, with all the talk of tapering, they didn't slow down the purchases like they said they were, which is interesting. So I don't know if they're going to reverse that policy in January or double the pace of tapering, as Powell said. But as you can see, we're well on track to hitting a $9 trillion balance sheet before the end of the tapering. And markets have been highly correlated to the growth of central bank balance sheets. Now, keep in mind, China is probably going to start growing their balance sheet, as they have not been needing to over the last year and a half, as they've had record demand for their exports. So they've had a very strong economy. Europe also just hit a new high, and so did Japan. Now, China is much more complex to track, but bottom line is expect China to really start to print a lot of money, or essentially lend a lot of credit into the economy for the next several years, as the US is going to have to slow that down. Okay, let's look at the reverse repo. This is also a quantitative easing buffering and a good way to predict when interest rates are going to rise. Bottom line is it's at $1.58 trillion. I'm going to get worried about tech stocks and cryptocurrencies as soon as this goes below $1 trillion, and probably much more worried as it goes towards $700 billion. So that's going to signal that essentially interest rates have a risk of rising. So for now, you don't need to worry and no changes. As we are following the new variant, we're worried about the price of oil and our inflation hedge. And so far, no reason to be concerned. This looks very bullish. Does look like this was not natural mutation. So who knows who made it? Good news is it's very safe and potentially could put maybe an end to all this lockdown madness. We will see. I wouldn't count on that, but as far as lockdowns this winter, it looks like that's not going to happen. In this chart, we're looking at the NASDAQ and the candlestick. We have interest rates in yellow, and then we have FAS, leveraged bank play, and NRGU, leveraged energy play. And so right now we're getting all three to go up. So that is very fun, but look at the outperformance in NRGU as those interest rates go up. So the NASDAQ doesn't necessarily hate interest rates rising. What it doesn't like are interest rates rising rapidly, and that really does deteriorate those tech stocks. Now in this chart, we're looking at emerging markets. I believe this will be your best performer this decade, and it's had a huge sell-off. So if you're looking for value, what a good buy. We got companies like Alibaba over 50% off, Tencent 30% off. And so EEM is a third China, but it also gives you exposure to South Korea, India, all sorts of good companies. I think it's over 4,000 companies in that ETF. Now look, it does not like those interest rates going down. It wants a booming reflation play. So emerging markets are likely to skyrocket once the dollar starts to cool off and interest rates rise. The main catalyst I'm looking for that to occur will be China increasing credit to make their economy red hot, while simultaneously the US passes the Build Back Better plan. I think that will give us the right trigger for emerging markets to outperform. Now I'm looking at FXI and MCHI, which do target China exclusively, to make sure the pain in that area is starting to slow down and stabilize. Because you can see twice the drawdown for MCHI and FXI relative to emerging markets. So that's really where the pain is. Now, luckily, we can look at Chinese imports and exports, and then look at policy choices China's made, and understand that this is a buy the dip opportunity. China's imports just hit a new record high, as well as their exports. And this is with China getting very, very tight and by design popping bubbles in their economy. So we're recommending to play that aggressively in our safe growth strategy with a ticker that leverages emerging markets ×3. All right, what's going on with the Russell 2000? It's been trading flat since February. This product also is not a big fan of a strong dollar or falling rates. Again, the same catalyst will likely take this to new highs. It did break below this resistance line for a split second and has bounced right back up. So this is a great leading indicator. A lot of crappy stocks have been driving this index up, like GameStop and AMC. So we've seen basically the Reddit army short squeezing hedge funds, completely comical lunatic style investing. And most likely that type of short squeeze won't work too much longer. I'm thinking that as the Fed tightens, some of this very, very risky style investing is going to be destroyed. So we'll keep a close eye on that. But so far, Russell 2000 remains straight, not giving us a signal either direction. Now, the European index looking very strong. It would not like interest rates falling, But as you can see in yellow, as interest rates did fall since June, this index has stayed flat. Okay, so that's very good. If the interest rates do pop back up and the dollar falls, expect EFO to break to a new high. This is Europe leverage times 2 plus Japan, huge basket of companies that were long in safe growth as well. So between EFO, EDC, and UPRO, you own every large corporation on the planet outside of a small handful of companies that are primarily just mining companies in South America. Okay, here's that dollar index. One of our best returns this year was simply from the dollar falling from 94 to 93 in October. I'm expecting over the course of time, the dollar will hit 90, and that's when we want to pull massive profits off of just about everything in our portfolio. Imagine the price of Bitcoin when the dollar falls from 96 to 90. Imagine the price of our oil play. So that's going to be a good signal. Now, one of my heroes, Jeffrey Gundlach, a billionaire and also known as the Bond King, believes we're going to see this go way below 90 due to massive twin deficits. And essentially, the US government's trapped in doing massive fiscal indefinitely, no plans to bring back manufacturing, to fix labor, and then these twin deficits that are just getting worse and worse every year. So he's actually predicting this could go towards 70. I think we will bounce at 90 before we worry about it going to 70. But just imagine how wild that would be. If we zoom out a little bit, the last time it was printing in that range was way back in 2010 and 11. Now I'm going to zoom back in and look at what's been driving the dollar higher. And I believe it's been primarily the Turkish lira. Which did again get bailed out, and the markets immediately rebounded the same day that bailout occurred. So just amazing how that was driving this action. But there you go, there's that Turkish lira crashing and the dollar, it's hard to see. Let me try to refresh that. So there is the Turkish lira cooling off. And again, it was with some pretty wild policies. It's not so clear if those policies will work long-term though. So we need to keep a close eye on it. And rest assured, I certainly am doing that for you. Okay, so I ignored a signal that oil was going to fall and interest rates were going to fall in June when we saw lumber futures crash. This led the market and was correct. Now it's leading the market higher. So as you know, I've had a bias towards the price of oil going up, that we would reflate the economy and restore labor markets. And I've kept you positioned with this strategy through the summer, though it was painful. Now it's starting to pay off. Today, we're seeing lumber futures continuing to rise. So I remain in that same exact positioning. Jeff says, you mentioned inflation continuing higher. What are some of the signals that you see? Yeah, we'll talk about that. I think rent and energy and wage pressure are the primary concern now. And there's really very little sign that that's going to slow down. So I am getting pretty worried that the Fed's going to have to react. All right, now in this chart, we're looking at the tech stocks that are still holding their weight and near new highs. So it's NVIDIA, Tesla, Apple, Microsoft. So the big question is, all the stay-at-home stocks going to catch up from the NASDAQ, which are down 50, 60%? Or are these leaders going to fall with their peers? So it's very important to watch these leaders. These are really the only ones still holding their ground. If I add back Google, Amazon, Facebook, they're not doing the same type of work that those others are. So I'm now focusing on price action in these four, plus Apple, obviously. So Apple, Microsoft, NVIDIA, and Tesla is where the pain is. Either these continue to go up and the rest catch up, or the opposite occurs. And so potentially some opportunity hedging wise to target some of these few standing leaders that are near all-time highs. Now, also in the S&P 500, I'm looking at where some of the money's now flowing into. And so the leaders over here that we're following are Home Depot, United Health, Johnson & Johnson, Procter & Gamble, Bank of America. So we're seeing that growth to value start to play out. And I do believe that's the main trend to focus on. A few tickers to specifically look at from emerging markets are Taiwan Semiconductors, potentially the most important company on the planet. We could see World War III develop over control over that company if China invades Taiwan. Doesn't seem like that would happen anytime soon, but that's something to at least have on our radar. Let's look at Tencent and Alibaba, down 39%, 55%. If the market is going to keep going higher and China is about to print money and stop attacking its own companies, I think you're going to get some great value from emerging markets, and specifically those two companies. So we're starting to see these stabilize and stop crashing. So very important to see, again, these two tech giants stop the decline and start to rebound. Not happening yet, but at least the crashing has slowed down. Now, the European index has been very, very strong. I'm only watching AstraZeneca and Toyota. That index is highly diversified. There's no position over 2%. If you look at the NASDAQ or the S&P 500 SPY, you have positions that are in the 3 to 6% range in FANG. So a lot less concentration. And again, we're just seeing very strong performance, very well spread out. So I love having exposure to Europe right now. In terms of calling a top on inflation and where we might see a dramatic change from inflation to deflation, especially in positioning, or in other words, when I would buy bonds, look for the dollar to hit 90 and Exxon to break above 90, probably above 100. I think they're going to head to a new high. The globe has now printed like $16 trillion, and they've made it very hard to increase the supply of oil. This is a perfect setup for big oil in the US to have a monopoly and to hit record profits and hit new highs, and that potentially could call a top. How long will it take to get there? It could take years to get there. Okay, so unless the Fed's going to crash the economy for political reasons due to inflation, expect to hold that NRGU. Currently, it is, let me pull up that chart. So currently, NRGU is at 165. This is going to outperform Exxon 3 times. So if we think Exxon could almost double, then we're looking at this going to $450 to $600, which I know sounds hard to believe, but that's the type of return we can make with NRGU. And more important, it's not a greed play. This is a hedge against inflation, which we see as the single greatest risk to markets. All right, next chart, we're looking at interest rates and oil, and they're very correlated. But we can see since June, the market's been in disagreement. Oil keeps trying to go higher, and interest rates keep trying to go lower. If I zoom in a bit, they do become much more correlated. My bet is as the Fed stops buying so many treasuries and money that's in banks, which is driving demand for treasuries, exits and goes into the real economy as we reopen, we're going to see oil go sky high and drive interest rates higher. That's my primary prediction for 2022 and beyond, is that cost of energy is going to go up, interest rates are going to follow it. So that means growth to value rotation. All right, copper at an all-time high price. Main driver of copper prices is China. So record imports, record exports, and they're about to pump credit into the economy. Where do you think copper's headed next? Probably higher. I believe copper is getting ready to break out higher. If it were to crash, I would be very concerned that China is not going to expand its credit and that we have big problems ahead. So far, copper's staying in this trading range, and we want to see it go to record highs. It's trading at the high. We want it to break into a new high. Okay, this is the Baltic Dry Index, not giving us the signal we would like in particular, but still trading at record levels. Based on the lumber futures, perhaps we see it bottom out in the 1,600 to 2,000 range and then go back up higher. So far, it's tracking the lumber futures delayed by about 6 months. So let's watch for this to bottom out and start to rise again. Baltic Dry Index is measuring the cost of shipping commodities from several key continents. Okay, bond market, we're looking at the front end 2-year. This is what's predicting future federal fund rate rising dramatically. And then the 30-year is predicting the growth of the economy over the long term. So what is this telling us? Bad news bears. It's telling us we have to fight inflation. It's out of control. And in doing so, you're going to crash the economy. So that's really not what we want to see. What we really want to see, to not have to change. Now, to be clear, my job's not to hope for some sort of outcome, just to predict what will happen and to position our clients. If we're going to stay in the current stance we're in, we really need the 2-year to slow its roll and for the 30-year to rise. And the bond market would be saying, okay, this growth to value rotation is going to occur and we're going to be all right. Right now, it's not saying that, it's saying the exact opposite, saying we have to hike rates to stop the inflation and it's going to crash the economy in doing so. So we'll look at the yield curve in a minute to expand upon that. TLT, J&K, LQD are the 3 key bond markets we track. If any one of these 3 are crashing, credit is becoming expensive for corporations or the government. Bad sign when you're living in a world that relies on a $2 trillion deficit from government to stay alive. And then we need $1 trillion in stock buybacks financed through credit markets for corporations to survive. So far, no pain. You can see these are not crashing. There's easy credit for everyone. All right, in this chart, we're comparing Bitcoin to Ethereum and the Grayscale Trust. Today, GBTC trades 20% below NAV and ETH 10%. Last week, they were both down 20%. So that means you can actually buy Bitcoin at a 20% discount today with GBTC, which we're about 8% long in safe growth. And you can buy ETHE 10% off with ETHE. Now, the smallest discount we've ever seen lately is about 5%. So that means Bitcoin could possibly, GBTC could outperform Bitcoin by maybe 15% in the next run up. That tends to be when that discount window shrinks. I think for a very short time, we've actually seen it trade at a premium, but I think that's unlikely because you got to realize Grayscale is taking 2% a year to hold your money. So anyways, what are we looking at in this? Well, in general, we've seen Bitcoin dominate through history and be very hard to outperform. If we go to recent times, though, we've started to see a little outperformance in Ethereum. So from August, Ethereum went up 150%, while Bitcoin only went up 90. And in the recent pullback, there was a little bit less drawdown. So Ethereum's getting a better return and less drawdown, at least in the last few months. And this is in anticipation of switching to proof of stake. They've been doing all sorts of things to get people to buy and hold Ethereum for a staking reward. So all sorts of gimmicks driving Ethereum. I like both. I think it makes sense to own both. One's more deflationary, Bitcoin. One's more inflationary, Ethereum. Ethereum is a big bet. that you're going to design lots of software applications that are successful, whereas Bitcoin doesn't need that to succeed. So I think it does make sense to have both. Okay, a lot of people are looking at that silver being way below gold. Will we see silver pick up? If the dollar falls, it could very well have a nice rebound. We've got a small silver position in the safe growth strategy. But if jobs are about to pick up, silver could get hammered lower as interest rates go up. So keeping that position smaller for now until we see how this labor recovery looks. The deflationary plays we like are the VIX, UVXY, which is the only one that's cheap today. EUO, which is the dollar versus the euro, that's expensive today and probably quite likely going to reverse as soon as the Build Back Better plan is passed. And we got treasuries trading 5% below CPI, which I think is the worst deal on the planet, especially now that we just agreed to increase the debt ceiling by $2.5 trillion. So in general, right now, I think the only smart way to hedge your portfolio is UVXY. Let's see. The question says, what's the relationship between banks and the bond market? Yeah, banks make more money as interest rates rise. So if you think the economy is going to recover and interest rates are going to rise, you want to be long banks and energy companies in general. Someone's asking, when will electric cars impact oil? Not for decades. Not this year, let's just say that. It'll get better now. Not anytime soon. Not this market cycle. Okay, next chart, we're looking at rare earth metals, REMX. That's what powers your electric batteries, whether it's a Tesla or an iPhone. Uranium, all right, well, let's get a bunch of electric cars, great, but are you gonna power them up with coal plants? I don't think so. We've got to go nuclear with uranium. Boil, quick short play for us with natural gas, and then solar for TAN. I want to get us back into TAN right now. We're long rare earth metals and uranium, and that's been a better play. As you can see, TAN continues to get a beat down as all that comes from China, and we're currently not so nice to China. We just banned their Olympics. We passed a Uyghur labor camp sort of bill, and China's been cracking down on itself. So expect TAN to most likely go up when the dollar comes down. Probably do boil play till February, and then we'll see what's the next hot inflationary play. Unfortunately, those food, soy, wheat plays are already breaking to new highs right now. So I'm not sure if that will be a good play for us by the time we get out of boil. With that fourth play in the high risk, I'm looking at plays that can double in a short period of time for a smaller position with high conviction. So it could be 10 is where we flip out of boil once we see those prices go up. Okay, we did look at that. Here's the Chinese currency. So Alibaba and the yuan are two good leading indicators for China. They're expected to try to cool off their currency because it's red hot right now. If this is going down, that means the yuan is appreciating against the dollar. So the yuan has been really the strongest currency this year, and then the dollar, and then everything else has been losing value against the dollar, especially the Turkish lira. What's going on in crypto world? We've got a melt up underway. So you hedge your Ethereum by being long Bitcoin. Those are the two most important plays. Right now, we are overweight Ethereum relative to Bitcoin if you're doing the 70-30 combo, but pretty close, once you look at the breakdowns. Now, who could hurt Ethereum? There's really a few companies, and specifically Solana, Cardano, Polkadot, Avalanche, all serious threats to Ethereum, and they're all trading around 1/10 the market cap. So if you're looking for some insane potential returns, those are the plays that I'm most interested in. Now, we're not using any of those in Portfolio Builder, just to be aware of where that risk is. Copper to gold ratio is trading flat, not giving us a clear signal as to interest rates in terms of whether they'll go up or down from here. If we zoom out a bit, you can see how extreme this gold copper ratio got from 2003 to 2006, predicting interest rates would rise, rise, rise. Eventually, it crashed the housing market in 2006 and then created a stock market crash in 2008. And you can see that was predicted 2 years in advance with the gold copper ratio. This is the CME Group's prediction for rate hikes. And boy, oh boy, they are pricing in a rate hike in March now. That 2-year is what's driving this. And so one rate hike's not the end of the world, but you go into consecutive interest rate hikes, the PPI doesn't slow down, the CPI doesn't slow down, the wage growth doesn't slow down, the tightness in the labor market continues to tighten, we're going to have a problem. So this is really what's key this year, is to watch this data and predict the Federal Reserve, most likely. Okay, so in this chart, we have the yield curve. So on the x-axis from left to right is how long you're going to loan money to the government, and the interest rate the government's going to pay you. Now, October 2022 is black. The green is March of 2021, and the blue is today. So without passing stimulus, we had actually a nicely shaped yield curve heading into winter. We pass a $3 trillion in spending, and the front end didn't really move, but the long end went up, and that created volatility in tech stocks, jumping to this 2.4% on the 30-year. Now, I'm predicting this can't go beyond 3 without major problems to financial markets, and that's when I would be aggressively buying bonds. In fact, we'll buy it as soon as it hits 2.4 again and build into that. Now, what happened over the course of the year? The economy fell, labor recovery was slow, and so now we've got bigger problems. We've got the 2-year has gone parabolic, up several 100%, and the front end is now inverted. So this is a very ugly, bearish signal for the economy. This is not good. We really want it to be the shape of the black and rising to much higher levels. And that would signal a nice, healthy economy. Instead, we've got stagflation. You got rising inflation and a dying economy. So that's what the yield curve is currently telling us, not the best signs. Okay, VIX is the hedging strategy. It's a futures product that has expirations every month, and you can look at the change of price over time to see where investors are worried about risk. And right now, the primary risk is in January, and it really dies down after that. So the market really wants to pass that build back better and then see how the bond market responds to that. I think that's really where we're seeing the risk. But I do think they will spend that $2.5 trillion that they've increased the credit limit for. These are just a handful of different cryptos I'm looking at besides Bitcoin and Ethereum. Just looking at some of the returns recently. AVAX, Polygon, up 91 and 84%. Binance Coin 20%. Solana 5%. In the same time period, Bitcoin is down 17%. Cardano's down 27 and Polkadot 24. All right, UK announced new lockdowns. Boris's political popularity is falling. I think they're sending people door to door to try to get people to take the medicine. Is just very interesting. Watching for those cases to fall, but again, it looks like we're not going to have a lockdown anywhere of significance, at least in the UK or US. So now just worry about inflation due to ports shutting down in China, which should be bad. South Africa went from low point to a peak and crashing back down in less than a month. So I think this can be very short-lived in the US. And if we look at the pattern, it looks like we've peaked out and we're going to start to fall from here. So we'll see. Now, a lot of the testing data is going to come in this week. So we probably will peak out this week and then crash into January, which is faster than I thought. I thought this might not die down till February. So we'll see. But so far, nothing to freak out about in terms of lockdowns in our oil play. All right, rate of change of cases starting to pick up here. Janet Yellen can issue all the debt she likes if reverse repos at 1.5 trillion. I'm not worried about rates rising. This is where we track issuance of debt. Okay, payrolls came in weak last month. Likely will be weak till March. This is what has to slow down. If the CPI keeps rising, we're going to have to hike rates, and the market's not going to like that. So this is very key to watch month to month. I think it's going to peak in 3 months. I'm expecting this could potentially rise for another 3 months. And if it keeps rising beyond that, I think we're going to have problems. Bank credit's continuing to grow, which is good, as the US is going to slow down its transfer of payments into the economy. We need banks to pick up the slack and jobs to pick up the slack. So we are seeing banks loaning money, and we're seeing consumers borrow on their credit cards. We're seeing retail continue to grow to record highs. Although it's slowed down, it's still at record levels. Job openings jumped again, showing there's a potential for jobs to continue to rise, but we're just not seeing people go back to work. So that's potentially problematic of a tightening labor market. Producer prices jumped after having been relatively flat for 3 months. This is a great leading indicator of the CPI, as well as the wages and the rent, which we know are likely to rise from here. Jobless claims flat. Average hourly earnings are rising. This is going to be inflationary. Salary growth still rising, although it's slowing down. So that's the big picture. Now we're starting to see the labor force participation rate grow. We're still about 4 to 5 million jobs short from pre-lockdown, just to get back to where we were. Now, to get to trend growth, we should probably be at 64% from where you can see we were growing from 62.4 to 63.4 over 4 years. So yeah, we're way below the trend we were on, and it's unclear if those jobs will come back online, and if so, what impact that will have on the economy. Not good. Balance of trade did fall month over month as the dollar's been rising. Now, I think with Build Back Better, we're going to see this trend continue to get worse and worse. If we look at the bigger picture, our balance of trade gets more negative over time, unless we're going to have a very populist policy to decouple with China and force corporations to essentially manufacture in North America. This will likely continue. So far I see zero signs that that's going to occur. So that's one reason to be bearish on the dollar. That they call it the twin deficits. Personal income not falling off a cliff despite the free money from the government slowing down, although I guess child tax credits are going to stop now. We'll see what impact that has. China's PMI is still at 50 and likely to expand as they start to print. Their imports, exports hit a new record high. Central bank balance sheets hit a new record high. And this keeps us in our exact positioning currently. To the news. So this is one of the plays I wanted to get us into. Maybe we're a little late, maybe not, we'll see. Right now we have oil, but we're seeing essentially food prices go skyrocketing. I think that's going to be the big problem of 2022. The fertilizer inputs are up tenfold, so it doesn't take a rocket scientist to realize the farmer's going to have to pass that cost down the line. Here's a look at the premium. So Bitcoin is 19% off with GBTC, and Ethereum's now 9%. Last week it was at 20. So there's no guarantee that discount window will collapse, but when the market's bullish, it does tend to get dramatically smaller. For very brief times, it's traded at a positive premium. But for now, yeah, why not get Bitcoin 20% off with GBTC? Makes a lot of sense. Here's the currencies that are the weakest against the dollar. Primarily a bunch of South American countries: Argentina, Chile, Colombia, and then, of course, the Turkish lira, which has been the main pain in the global economy, in my opinion, that was bailed out. We'll see if it continues to work. It's a big gamble that Turkey's playing on their economy currently. We're starting to see some of the radical right-wing folks turn on Trump due to pushing the warp speed stuff. Interesting to see how that plays out and what impact that may have on midterms and the 2024 presidential election. Not making too much of that yet. Now this chart's looking at the Michigan economic confidence indicator and the impact of hiking rates and how that crushes confidence. So all he's trying to say here is confidence already crashing and we're about to hike rates. And the reason why the confidence is crashing is because the inflation is horrifying. And now we're about to hike rates into the inflation. So is it going to be a disaster, or will it increase confidence if inflation comes back down? In general, we can see they got away with it in this period from 1995 till 2000. In 2008, it worked for a few years until you got the housing crash. So we'll see how that plays out this time. Here's a look at the Treasury's balance sheet. Get ready for it. She's about to start selling lots of debt to fill up the coffers. I think they wanted around 800 billion or more. And so she has full ability to do that. And that's going to likely drive rates higher as we start to fill up the tank. Okay, this could be very inflationary. So we're looking at the mortgage payments going up 35% in Austin, for example, and 35% in Phoenix. But meanwhile, the rent's only up 9 to 12%. So that's a very delayed number that tracks the housing costs. So rent, wages, and energy could be very problematic for that CPI and cause the Fed to be forced to hike interest rates aggressively until it breaks something. And so that's our primary concern leading into 2022. All right, I think that does catch the top headlines. So let's go ahead and get ready to review asset allocation and investment strategy. But unfortunately, if you're not a paid member, this is where your video ends. You need to call John to upgrade right now at 505-610-1334. We're positioned for inflation to skyrocket, make a lot of money right now. But again, if the Fed wants to end this party, they can, and they may have to. When that is going to happen, we're going to completely change course to a deflationary strategy, and you're not going to want to miss the timing on that. When to take profits and what to invest in next. So call John right now, 505-610-1334. Okay, very good. So now we're going to get ready to go into the customer only asset allocation portion of the video. So let me go ahead and pull that up.